All right, let's get right into it. The AI stock rally has just gone completely vertical, and really there's only one question on every single investor's mind. Is this a historic bull run that's being fueled by a genuine tech revolution, or are we just watching a massive bubble that's about to pop?
I mean, you can feel it in the air, right? Every financial news channel, every analyst, practically every headline seems to be screaming that this is all going to end in tears. That fear is palpable. And you know what? It's totally understandable.
So the big question is, are we just watching a replay of the dot-com bust from back in 2000? Or is there something different going on this time? Are the fundamentals telling a completely different story? That's exactly what we're going to unpack right now.
So here's how we're going to tackle this. First, we'll look at those echoes of the dot-com era. Then we'll dive into a really powerful counter-argument from Fidelity. After that, we'll get into the weeds on valuations, check out the global economic forces at play, and finally, try to figure out what it all means.
Okay, first things first. Let's talk about why everyone is so on edge. The parallels to the late 90s, well, they're pretty hard to miss.
Now check this out. The first two rows here look pretty much identical. You've got that classic FOMO, the fear of missing out, fueling this absolute mania. And it's all centered on a brand new, supposedly world-changing technology. But look at that last row. That's the game changer. Back in the 90s, most of those internet darlings were just burning through cash with zero profits. Today, the giants leading this AI charge are literally some of the most profitable companies the world has ever seen.
And that massive difference in profits? Well, that's the bedrock of the really compelling counter-narrative, one that's being pushed by one of the biggest names in the entire financial world. So this guy, Jurian Timmer, he's the head macro strategist over at Fidelity, and he just dropped this analysis that totally flips the whole bubble story on its head. His argument is incredibly bold. He's saying not only is this not the peak, we're not even close. And this chart illustrates his point perfectly. What Timmer did was he overlaid our current bull market with the path from the dot-com era. And honestly, the alignment is just uncanny. According to this map, we are not at the peak of the year 2000. No, we're actually back in 1998, just past a little mid-cycle hiccup, with the projected top still maybe 2 years away.
So what was that mid-cycle scare he's talking about back in '98? It was the spectacular collapse of a massive hedge fund called long-term capital management. It caused a huge panic, a really sharp dip in the market, but what happened next is the key. The market shook it off and then went on an 18-month tear to its final peak. Timmer's saying that our recent worries, things like trade tariffs, are basically our modern version of that LTCM moment, a temporary scare, not the end of the story. This brings us to our next point, because Timmer's argument isn't just about pretty chart patterns, it's about valuations. And this is where the story gets really complicated, because depending on which numbers you look at, you get two completely different answers.
Timmer's go-to metric is something called the 5-year CAPE ratio. Basically, it just smooths out earnings over 5 years to get a better sense of value. By this measure, the market's sitting around 32.2. Now, that's definitely expensive, but it's still below where we were at the dot-com peak, which suggests, hey, maybe there's still more room to run.
But here's the problem. If you look at almost any other traditional way of measuring the market's value, the alarms aren't just ringing, they are absolutely screaming.
For instance, take the more common 10-year Shiller CAPE. It's hanging out near 40 right now, a level it's only been passed once in all of history, at the absolute tippy top of the dot-com mania. And then there's the Buffett indicator, which is at a mind-boggling 224%, just blowing past its dot-com high. These are flashing bright, bright red.
And then you've got the concentration issue. The Magnificent Seven, that small handful of tech giants, now make up a staggering 35% of the entire S&P 500. This makes the whole market feel a bit fragile. I mean, if just those few stocks start to wobble, they could drag the whole thing down with them.
So we're right back to this fundamental puzzle. Yes, valuations are huge, just like they were in the dot-com bubble. But the earnings that are holding up those valuations today are incredibly strong, whereas back then, they were mostly awful. If earnings keep delivering, this whole thing could keep going. But if they stumble, things could unravel very, very fast.
But here's the thing. None of this is happening in a vacuum. To really get the bull case, we need to zoom out and look at the huge economic forces that are propping up this market.
Right now, there is a tidal wave of global liquidity, which is just a fancy way of saying there's a ton of cash sloshing around the world's financial system. You've got China and Japan pumping stimulus into their economies. The US Fed, believe it or not, is still quietly injecting about $40 billion a month into the system. Throw in expected rate cuts and looser bank rules, and you have this powerful wind at the market's back. Timmer's chart isn't just floating in thin air, it's riding this massive wave.
All right, we've looked at the history, we've seen the conflicting numbers, and we've talked about the bigger economic picture, so let's put all the pieces on the table and see where we actually stand.
So it really boils down to two competing stories. On one side, you've got the bull case from Timmer. It says the historical charts line up, valuations aren't quite at the peak yet, and it's all supported by real earnings and a flood of cash. But on the other side, you've got the bubble case, pointing to record-high valuations, dangerous concentration, and a fragile setup that could fall apart if those big tech leaders take a hit.
So here's the bottom line. Is Jurian Timmer's analysis a sober, data-backed roadmap for the next 2 years of this bull market? Or, as one critic so colorfully put it, is it just premium-grade opium wrapped up in a fancy Fidelity chart? A feel-good story that's ignoring all the red flags? That really is the billion-dollar question, and for now, the answer depends entirely on which story you choose to believe.